Good afternoon, everyone. I don't know if you can see my screen. Malavan, can you see my screen?
Yes, I can.
Okay, perfect. So I believe everybody...
Sorry, please feel free to keep your videos open, but mute your mic. Okay, you're most welcome to keep your video open. Thank you.
Thank you very much, everyone. Thank you for joining this afternoon. So we are now at the second session running. Last one was last month, and it was about second line of defense. This month, we're going to focus on mitigation of operational risks and explore reasons why financial institutions, banks, and others, probably what are the reasons why they're getting it wrong. Sometimes, not all the time. We're going to start with a very short poll. So the question is, and the answers that you can give are very simple. It's basically a yes or a no to the question. So the question here is around risk appetite. And I would like to know if the company you work for, financial institution, or a bank, do you have a set risk appetite in your company? So a yes or a no answer. Okay. So I guess we've got 75% of you have responded yes to the question, so that's already a good start. It's so why do you think, really, why do you think the risk appetite is important, and why does it why do we say that it's such a powerful tool in in getting the risk mitigated? I mean, you've seen this slide gives you a bit of tips, but really it's not about, when we talk about mitigation techniques, we don't necessarily only talk about controls. So there are a number of mitigation techniques that we can apply. And really at the heart of that is the decision-making process, whereby we know that the company, where the company can operate, where the bank can operate, what are the limits for writing business. And these limits can wear a number of forms. So I'll give you some tips there, but I would like to hear from you. For those who've set, or even those who haven't got a set risk appetite, set usually by the board within their bank or financial institution, what kind of statement would you typically see in a risk appetite? So you might want to unmute at this stage.
Guys, please feel free to participate.
So what do you think are the statements that would typically feature in a risk appetite statement? I don't know if Anand or Mohamed or Ilyas or Ankur. And for those who haven't, what do you think would be good to have? Because maybe your risk appetite doesn't cover necessarily all aspects that you might come across in a financial institution.
We should include probably what business you cannot do, which jurisdiction or what type of industry business you cannot do.
That's right. So I don't know if TradeWing has probably got some wordings around that, and they probably clearly state which geographies they don't want to do business with.
Yes, it's predefined specifically for industry and geography, saying that how it should not be focused. It's not predominant. For example, petroleum, we do not want to focus on petroleum industry, or we don't want to go to country like Syria or Iraq.
Okay.
Like
okay. Yeah. So that's a good start. So you've got, yeah, the industry type. Usually there are some very sensitive sectors which are higher risks. And actually by defining the type of business and the type of customers, but also not only customers, you also have 30 providers or partners. It goes much beyond just clients. So you're going to define those which you permit business to be done with. And some of these might bear higher risks or might bear normal risk. And usually, you know, the risk appetite will tell you the prohibited type of business. So what we call the business restrictions, really the prohibitions, like in Syria, we don't want to do business with companies established or registered in Syria, or Iran, or Somalia, or, you know, for here, maybe in the GCC, we've got also a general embargo with Israel from the 1970s. So you can see already the type of restrictions you have. So you have the absolute no-go, prohibited, totally prohibited. And then you might have as well some limits that the board sets for specifically higher risks type of business. So I think, Ankur, you know, the weapon industry and the arm industry, military industry, defense might not be completely prohibited, but there might be restrictions to it. So the board might set, when they set the risk appetite, they might say, we only deal with this list of companies, or we will only deal with companies who are not selling to these kind of countries. No countries in conflict, for instance, or where there is already reputational risk related to, you know, civilians being killed and atrocities being undertaken. So this is more from a reputational risk, but also, and the reputational risk is high, especially for financial institutions, because everything is based on reputation and trust. But so not only linked to regulation, strictly speaking, and sanctioned parties. So you can see already that there is the must do. We need to comply with sanctions. So in this case, you know, the set risk appetite will say, we will not deal with sanctioned parties because we don't violate sanctions regulations. But beyond that, we want to put business prohibitions to the country as a whole, whether it's sanctioned individual or not, or sanctioned company or not. And as you say, also some industry types. Now, what other, you mentioned, you know, the type of industry, we've looked at the geographies. What other business restrictions or prohibitions could be in place, some of which actually could be also driven by regulation?
Maybe credit unions, casinos, and also like especially these credit unions, which are non-financial banking, which maybe MSBs.
Okay, yeah, MSBs is an interesting one. It's some institutions might want to put them in the high risk category, and some of them might say, we don't want to deal with them at all. You're right. So credit unions, absolutely. In terms of casinos, yeah, because they are higher risk. Now, as you may know, FATF has, there are recommendations around DNFBP, so denominated non-banking, non-financial institutions providers, and they would be subject to some kind of regulation. So don't know if you're aware, but as long as these type of institutions are regulated under one reputable or FATF member country regulation, then this could be completely proper business to do with. So here, if you are in a compliance or risk management functions, you might alert the board to say, look, maybe we don't need the full prohibition onto this type of industry because we might miss business, but maybe we can actually tailor that prohibition to only some specific categories of casinos, real estate agents, etc., etc. So that's where actually compliance can not be only the no person, but say, look, some of these players are absolutely fine because they are now subject to very heavy regulation. You know, I don't know if you're aware, but casinos, they are subject to SARS reporting the same way as financial institutions. They need to do a KYC CDD of their client. They are subject to a very, very high level of regulation now. And they're not the only ones. But so that could open up as well business opportunities if you know exactly which ones really pose problem from a risk perspective. Any other?
Also, I want to add a point, Anna. Like the individual may not be disclosing the facts that he is going to do a prohibited business, but however, when he does or is onboarded as an individual, as a sole proprietor, while we do the transaction monitoring for such individuals, we are able to find that whether he is doing a prohibited business or no.
That's right. Yeah, that's right. You've got mechanism in place, and that's exactly the point you're very much onto the point. You have to you can set good business prohibitions or business restrictions, but the main aspect then is to make sure they're adhered to within the company, within your financial institution, within your bank. And that's not as easy as it sounds. And that's really where most banks get it wrong, because they set very nice risk appetite when they manage to set clear and precise one and communicate that risk appetite to at least the first line and the relevant staff that are going to execute business and execute the strategy of the company as said by the board, then there is a risk that really the strategy is not applied. So I'll give you an example. I was working for a bank about a few years ago, and some of the risk appetite was set, but in a very messy way. So you had the board level, at group level, setting up risk appetite. Then you could have country individually setting their own risk appetite and additional prohibitions. Usually it was layers and layers. But then because it was a matrix organization, you had the product, the regions, the country, and the prohibitions and restrictions could come from these various different, heads of or committees. And it was, at the end of the day, when you were sitting in the country or a region, you didn't know anymore what were the business restrictions for your jurisdiction. You were sitting in Qatar, say, what am I supposed to, what can I do, what can't I do? Because it was so messy and it was coming from all directions that there was no express set appetite clear for each country that was aggregating the various layers of prohibitions and restrictions coming from various parts of the group and the region as well. So just to be clear, the risk appetite set is only as good as it is properly and clearly communicated. And then you have the aspect of, is it really executed on the ground? So obviously, if it's not clear to people, you've got the risk of, you've got high chances that it's not being applied. I don't know if some of you have experienced something similar, but in your current job or maybe in previous experiences, but that's what I've encountered as one of the issues around the strategy and the risk appetite. If any other business restrictions that is very, very common, not only in FATF, actually it's coming from FATF, but also I know in the UAE, it's one of the restriction for business, and it has to do with the legal form of the company. I'm giving you a hint. Siva or Muhammad or Anant, or Anko, any idea?
A company with bearer shares?
Yes, bearer share companies, that's right. Anonymous account, bearer share companies, yep. So any legal structure where it is impossible to identify the beneficial owners, ultimate beneficial owners. And bearer shares, due to their nature, you don't know who owns the shares. The bearer, but the bearer can change one day to the other. So bearer share companies are actually prohibited in the UAE. You cannot do business with them, and any kind of anonymous party. So anybody who's got a trick name or a nickname or a pseudo, this is not tolerated. Okay, so thank you very much. That was a good start. We're going to go into the next. I'm going to share my screen again. So we've looked at the business restrictions. We see how a powerful tool it is, because if we know in advance the risks you want to take, then as long as it's, as long as it's executed on the ground, you should be, in theory, if you've done your estimates properly, you should be within your risk appetite. Your risk should not exceed your risk appetite, in theory. That's the theory. So, okay, so going back to, sorry, I've got some problem with my, no, sorry. Voilà, yeah. So in terms of the effective mitigation techniques, we've seen, we've just discussed about that a bit earlier. So we've looked at business restrictions. These could be prohibitions or high risk type of business that we want to then limit. So if you have high risk type of business, your risk appetite should set the limits in terms of monetary values. Let's say for credit risk, you're all familiar that you would say, I don't want to lend money more than X amount of money to one individual company because I'm running into concentration. Yeah, so I don't want to do more business than X in this type of country because they are high risk, and so on and so forth. But again, business restrictions, you need to have mechanism in place, especially at the second line of, but definitely in the first line, but also at the second line, to make sure that these are applied. Very important. I know some companies, some banks, I'm not going to name them, they've set a brilliant risk appetite, but no one is checking what the first line is doing on the ground. So, you discover that they've been doing business with Iran or with Afghanistan and Somalia, where actually these countries were prohibited in the risk appetite statement, because no one checks that this is actually the case. Yeah. So we need to, and this is really probably the most powerful technique of reducing risk. It's already knowing what risk you want to take, what level of risk and amount, quantum of risk you want to take, and making sure that the business underwrites the business, underwrites activity in line with these limits. You can also apply business restrictions, so they're very proactive ways of mitigating risk, and also they can be applied once if you realize that the bank or the financial institution is actually running into a risk level which is above risk appetite, or which is getting very close to risk appetite. And what you can do is actually get these restrictions even stricter. So for instance, I'm going to say, I'm getting my limits down per country. I'm exiting one country, or I'm no longer underwriting in that country because it's already, I've already got that many countries high risk, and I want to stop for now because I'm getting very close to my limit. So they can actually be revisited as you continue business all year long, and you can actually loosen them as well if you see, well, actually, I've got capital, I'm way below my appetite. So either the business doesn't understand what they can do, and then I can actually mention that and get that communicated to them. Or maybe it's because we are very, very conservative. The bank is very conservative, so maybe let's open up a little bit more. So this is where compliance and risk can actually help the business meet their targets while remaining within risk appetite. It's a very fine-tuned exercise, but it's very interesting. So this is how business restrictions work, very proactive, reactive as well to some extent, but in any case, if it's well done, it's very powerful, very, very powerful. And then you've got this whole other set of techniques that you've got in front of you. So some reactive, some proactive. Controls for me, it's somehow, it's reactive and proactive because you have obviously detective control and preventive controls. Process design and product and services design, this is really where you can make a difference from the start. And you can actually, by enhancing and designing smart ways of conducting activities or designing product and services in line with the client's expectations or the use or the target clients, you can actually avoid a lot of risk related to product and services. For instance, a number of suitability risks are related to product and services. You've heard about a number of cases on suitability and market conduct. This is typically product and services design, a lot of those. And in process design, it's about the process workflow. So, you know, where do I have gaps in my overall end-to-end process? Do I understand these weaknesses? And how can I design the process so that I don't have to then plug in controls to try and mitigate the risk? But I'm doing that proactively by designing the process in a smart way so that I don't have these weaknesses in my process. So I stop there for a moment. Which ones of you are actively involved at the design and initial stage of process design and product and services design? I mean, it's not a poll, but opening up to the audience. I know this is sometimes a pain point in financial industries. What is your experience in regards of being proactively involved in these discussions and in the design process?
Compliance is involved in the product approval process, maybe not at the designing stage.
Okay. Thank you. Anybody else? Do you feel that you could be more involved to actually participate into the design of these services, products, and processes, and therefore maybe pick up relevant, you know, early on some potential weaknesses and fix those in the design itself, as opposed to then come later and have to, you know, layer controls and here and there, but to mitigate the risks, where really we could have avoided the risk by designing processes, product, and services at the definition stage. Anant and Mohamed, what is your any experience in that space?
I would be more of into the process controls, as I work for JP Morgan, and people out there just don't have a backup team. So they basically train us on how do we train for the new employees and the people already existing in, with the new changes and the regulatory requirements that are coming into our workflow. So basically it's a more of a transaction monitoring role. So having a case-to-case red flags and the nature of industries, how do we mitigate that? That is what I'm more into. So experience is equivalent, similar to that only. That is what I can say. Yeah.
Okay, so Anant, what we've discussed before, I guess, is very relevant for you is in terms of set risk appetite, business restrictions. That is where your transaction monitoring rules needs to be really aligned to these limits, these business restrictions set by the board, so
Yes.
that you're making sure that these are being applied and you're picking
Yes.
those who are not within appetite. Okay. Okay.
Yeah. Thanks. Yeah.
Okay, very good. So we are, let me share back my screen. I will, we're going to get back to, our mitigation techniques and what we can explore further. I think the culture aspect is something I would really like to tell you more about. And I've got a little poll for you. That's the number 2. So what is it for you, or at least the company or the bank or financial institution you work for? To what extent is culture and conduct really key to your organization in establishing a successful control environment? I'm not saying control, I'm saying control environment. Or is it really considered as secondary or even optional? We've got more answers to come. So all of you have said it's key. It's believed to be key. That's great news. That's great news. So can you illustrate, or do some of you want to illustrate in what way do companies demonstrate that it is key for them? How do they demonstrate that it is key? Yeah. So we've looked at a number of, and I'll skip to the next slide because I think that could be opening up for some debates. So this is really the latest data from, I don't know if you know ORX. ORX is a central database. We've got about 80 banks worldwide, or even more than that now, who are actually sharing data with this organization, which is a database. And they collate, on a monthly basis, they collate losses, operational risk losses for all their member banks and financial institutions. So you can have a look at the top 5 operational risk loss events from ORX News. You can have that, you can go onto their website, it's publicly available. What is interesting to understand here is that in May, 4 out of the 5 top losses were due to conduct, right? So if companies, like you, all companies were really, really focusing on culture and conduct, then why do we have so many of these losses, which are actually related fully to code of conduct and ethics and culture? So we've got business or market practices, yeah. Come X deals. We've got the second one is external theft. So that's not fully related to conduct, strictly related directly to conduct and culture, but might need to have a bit of a, you have fake email scam here. So, conduct and ethics is not only applying the laws and the regulation and not defrauding the banks or internal fraud. It's also about a duty of care for the company you work for, a duty of care to your customers, a duty of care to all stakeholders that you are dealing with. So here, I would even argue that fake email scam, somebody must have clicked on a link in an email without really paying attention. Recently in an organization I was working for, we had problems with email scam, and some some employees actually clicked on the links without really paying enough attention to what it was, despite having gone through the InfoSec training at least 3 times since the beginning of the year, right? So these people have gone 3 times through the same training since the beginning of the year, and that's still not good enough. They've clicked on the link, and it has created a cybersecurity issue. So if we look really at even the second one, we could argue that's probably indirectly linked to culture and conduct and ethics. It's about a duty of care. Suitability, disclosure, and fiduciary, of course, that's all to do with, with conduct again and ethics. Number 4 as well. Misleading customer about charges, definitely. Giving misleading and inaccurate information, again, that's really not putting the customer at the center of what we do. And I can only but look at the number of values and mission statement on banks' websites and financial institutions' websites say, we are customer centric, we love the customer, we love you. And look at all of these practices. And this is not even, if you're looking at the big losses, you're looking at the location of these losses. It's not happening in the developed world. It's happening in the underdeveloped or developing world, or in frontier markets, or in regions like here, or in Southeast Asia. These biggest losses are actually in developed world, in Europe and the US. Actually in countries which are, according to Transparency International, are some of the best, as per Netherlands or Norway. Actually, yeah, Netherlands and Norway, United States, maybe not as good as these two, but still, they are at the top of the table. When you look at the June 2020 data, the 5 top losses in June are again the same. It's about internal fraud, it's about suitability, it's about market conduct, it's about disclosure. Different names here, and you can recognize the names. Some of them are not in Europe. Most of them are in Europe. Some of them, number 4 is in South Africa. But you can see again, it's all about culture and conduct. It's all about, and most of them are conduct with respect to the customer. So there's something really here. If it's so key, why do we get it wrong? Why can't we avoid these losses? I'll open up to the floor here, and I'd like to hear from you. Why do you think, if it's so high on the agenda, if it's so key to banks and financial institutions, why are we seeing this? A little bit more, just if you're not convinced. This is from 2011 to 2016, a bit dated, but believe me, cybercrime is not in there. And you can see here, execution, delivery, and process management. We talked about being part of the definition of processes. That's one of the aspects. Client, product, and business practices, again. So is it that we are not proactive enough, we're not a second line and risk managers, we're not involved enough in the design phase? Or is it a communication issue? Or is it really that we don't communicate enough? Or is it consequence management, which is not embedded? Is it due to the remuneration regimes or remuneration structure that people are under? All of these could be contribution factor above and beyond just having maybe a code of conduct and ethics document that people read once a year and sign. So what is your experience in what banks and financial institutions do to address this problem, and what can be done differently? Aaron, maybe you've, with your governance background, you might have some idea. Or maybe Anand or Muhammad?
Sorry, I couldn't hit the unmute. From a conduct perspective, obviously, as you said, to align your performance and remuneration is a key point, but also making sure you have clear structures around signing off on products, processes, oversights around that, and making sure that variations can't be done unless it's an approved structure, either through an approved committee or an approved individual, and also having clarity around who actually has that authority.
Mm-hmm, mm-hmm. Yeah, very good point. Yeah. So do you believe there could be conflicts?
Definitely.
Yeah.
There'll be tensions between the business and the risk control functions. Obviously, business may want to go in one direction. They think they have the authority. There'll be tension between different departments. Yes, to answer your question.
Okay. Okay. Yeah. Is it also? I mean, we claim, most of the banks claim they are very customer centric. They care about the customer. Do you believe that the message is strong enough internally? And how is this practically? How is this executed? The customer centric and the we care about the customer kind of message.
I think, obviously a lot of banks have it as their, you look through the strategy of any global bank at the moment, and they're all focus on technology focus. Two of their top 5 focuses. How does it play out on the ground? So on the ground into the customer base, obviously there is a service culture which will be there. The challenge then is, what is an appropriate conduct, particularly around pricing. To give a good example, what is an appropriate price? If the customer is first, you give them the lowest price. If you want to make a profit, then you obviously need a higher price. I've been doing some work in financial inclusion recently, and what we've seen is, if you look at NIMs on products within a standard banking area, maybe 5%, 10% in that area, credit cards, maybe up to 20%. If you look into sort of financial inclusion, higher risk, you see higher returns. But is it appropriate to have a NIM of 15, 20, 25% for particular individuals and others? There's lots of questions around that. And obviously banks need to find an appropriate model in terms of what they want to do. And I think certainly with the conduct culture, which is over the last year, has been a lot more focused on what is the appropriate approach, what is fair, and a lot of questions around fairness. And I think that's obviously a good step forward. Yeah.
I think also in terms of the margins that the banks want, I mean, there are two aspects. There is how much margin or how much profit do you do on your services, and I think it's both in terms of percentage or basis points, as well as so it's percentage and absolute value. And although it's the percentage and the basis points would be very minimal for low risks, they would be actually, when you're looking at high risk, the margins are actually quite fat sometimes. And also there might be, I'm not saying it's always the case, there might be a miscalculation of the risk associated with some geographies, because it's countries that we don't know as much. It's felt as high risk, but do you really have the data that supports that your risk assessment is that high for some of these markets? And I'm not sure where necessarily the truth is, but sometimes it's very easy to make a lot of money on countries or on individuals or segments which have very little access, and they have very little choice in terms of product offering and service offering. So yeah, thank you very much for sharing that. That's actually a good one, and I think aligning with performance with remuneration is another one which is really a pain point as well. So we're going to go to the poll number 3. We've looked at the different techniques. So we've looked at culture and conduct, how important it is, and I can only emphasize, but companies, banks, financial institutions, they spend a huge amount of money on systems. They spend money on processes, not as much as on systems. And how much do they really spend on people? At the end of the day, people design the processes, they operate the processes, they also design the systems, they test the systems, they maintain the systems. So wherever you look at, whether it's internalized or if you outsource, it's all down to people at the end of the day, or most of it, 95% of it is going to be down to people. I'm sure when you've looked at the root cause analysis, you've actually seen that many times, if not all the time, when you had a failure or a near miss and you've done a root cause analysis, you found out that actually the reason is people. Not very long time ago, I did a root cause analysis in a bank. There were some major control failures, and we're coming to control now, major control failures. And when we were looking at the reasons behind the failures, looking at that, you talk to somebody, they say, oh yeah, but this person knows exactly what she's doing. And then you go to interview the person who is executing the control on a daily basis, and she looks at you, she says, no, this is not a control that I'm supposed to be executing on a daily basis. And I'm like, well, there's a problem of communication. And she says, well, there's no document. It's not even documented. I've not had any induction. I haven't been told that this control is key. That actually it's a control that is really key because it's a sanctions control, right? Sanction screening of transactions. But she's a professional at the same time, so she should know that it's probably key in a bank to review transaction screening alerts, and so on and so forth. So you have actually, when you were looking at the many different failing points for the failure of that control overall, it was all down to people. Not understand, lack of training, lack of induction, lack of supervision, lack of execution, lack of understanding, etc., etc. And even for those who were bystanders, they noticed some, inaccuracies or anomalies. They didn't raise any issue because, you know what, if I raise something, I'm going to be asked to fix it, or I'm going to be asked to do something about it. So they didn't really want to think. They didn't really want to raise the issue, and therefore we've got this problem of care, care of the company, care of the customer, care of something might go wrong, and I'm going to go and have a look at it because there might be something bigger than I think there is. So anyway, going now to the poll number 3, I'm going to ask you, and it's a simple yes or no answer. How many of you had a significant issue with the key control over the last 12 months? It can be within your organization, or for those who are consultant, maybe you've been called to do a risk and control assessment or root cause analysis. So let's see what the results are. Okay. So 1 didn't have an issue. 2 had. Well, I had many, so okay. We're at 50-50. So if I had mine, I would be a yes. No, okay. So it's like, it's like 50-50 then. Manavan is not, Manavan, you're not answering, obviously.
No, not me.
Okay. So, okay, the first problem is the very definition of control, right? So when we're looking at controls, which is one of the most, people we think mitigation equals control. Right? We've seen that the battery and the arsenal that we've got at our disposal is far more than just controls. Controls for me is really where we haven't done the rest. We haven't been proactive, we haven't designed processes efficiently, therefore we need to put a control because we've got, a failure points. So when everything else has been exhausted, and given we have the proper conduct culture and ethics framework in place, then really control is what we can do at last to mitigate the risk. I was very surprised recently. I was talking to one of my clients, and they say, look, Anne-Sophie, we're going to do a risk and control self-assessment. I said, fine, yeah. I think it's a good idea. Actually, I had advised them to redo one of those on one of their processes. And they say, well, you know, one of the big four, I'm not going to name them, one of the big four, they've come up with a matrix. And for each process, we have to tick the box. Yeah, okay, I said, fine. Show me the matrix. And interestingly, in the matrix, we had what I've written down here below. So the controls, they had different types of controls, yeah, per process or per activity. And these were the ones that were on this sheet. So you on this sheet of on this matrix, you had policy document, audit trail, delegated authority, complaints analysis, training program, reporting. Then you had things like segregation of duties, you had for rights check, you had reconciliation, etc., etc. Now, why do you think I've put a toilet paper here, or a toilet roll? It has to do with the first item on the list, by the way. So do you consider a document, a piece of paper, a control? Anyone has a view?
Control.
Sorry, you want to say that again?
It's more like control.
Okay, so why is a document not a control?
No, document, I intend to say document is a control.
Okay. Any other view around the floor? No, everybody else has got the same view?
It's a good thing to have.
Okay, yeah, but is it a control or not?
I would say it's not a control. It might describe a control, but it's not a control per se.
Okay, so I mean, and again, views can differ, but for me, a piece of paper is not a control itself. A control is an activity. So the policy document in itself is not going to reduce the risk. The policy document and the procedure are going to be supporting the execution of the control, but it's not the control per se. So if you're telling me reconciliation of a transaction with the documents supporting the transaction, yeah, that's a control. But the policy document itself cannot be a control because it's not an activity. Similarly to audit trail is not a control. It demonstrates a series of activities which are interlinked, and it therefore demonstrates the source for an activity or a consequence or result, but it's not in itself a control. Complaints analysis, that's an activity, but does it really reduce a risk? Does analyzing complaint reduces directly the risk? No, it might help understand potential risk. It might help understand root causes for some issues or early signs of issues that have not been reported yet or identified yet within the organization. So it's one way of knowing there is a problem, but the complaints analysis is not a control. Regardless, I'm saying all of these 6 elements were on the Big Four matrix for control. And the problem is when people think that an audit trail is a control, then they're going to stop there and they're going to think the risk is mitigated. The risk is reduced systematically by having an audit trail. No, can't be. As Aaron said, I would be the same view. I would share the view of Aaron. I would say all of these will support the control, will demonstrate that the control has been executed, i.e. audit trail. It will demonstrate, it will support the execution of the control. It will be a control attribute maybe. But my view is that all of these, most of these here, would not be a control in themselves. And the paper roll, think about the analogy here, but it's not because you've got a paper roll next to you that you're going to necessarily use it and use it the right way to do whatever you need to do for, for the right outcome for yourself.
And so can't it be a consent individual is giving before performing an activity?
Do you mean what I'm saying? What I'm saying is that it helps with execution of the control, but the policy in itself is not a control or procedure.
Okay.
That's true. I think it's a medium of control.
Yeah. So be very careful when you do your risk control self-assessment. If you see some of these as control to mitigate the risks, for me, that would be a first flag for review. Yeah, have a further look and make sure that a control is an activity that systematically is going to reduce the risk, whether it's preventive or detective, because it can reduce the probability of occurrence or the likelihood of occurrence or the severity or both. So that's, but let's see, it's interesting to have a view, and the two can be found in various financial institutions. I mean, the one I was working with recently, they had all of these listed as potential controls. But they would be, I'm not saying they're not key, but they would not be reducing the risk systematically. Another aspect I want to highlight your attention onto, and you've probably heard about the Wirecard case. I'm sure you've heard the news, where, a third of the balance sheet of a payment services company. I mean, Aaron, you've probably felt the ripple of that in Singapore, because Singapore and Dubai were involved jurisdiction in this whole case, which is not finished to be investigated yet. And really, there was a very interesting. I heard a podcast on that after the case was analyzed or was being analyzed. And there is as well, so there is the control. So what is the control? And then there is a big question of how many controls do you need to mitigate a risk? Well, guess what? I don't know if you're aware of the bystander effect. If you don't know about the bystander effect, I would really invite you to go and check it. Wikipedia has got a good enough definition of that. But in a sense, this is exactly what happened in the Wirecard case. Yeah, there were so many big names after that. The BaFin is the German regulator. MAS is the Singaporean regulator. You had EY being very reputable firm, that maybe they're going to end up like Arthur Andersen with Enron in the Enron scandal. Maybe it's not out of question yet. We'll see what happens with these guys. Basically, a third of their balance sheet is missing. A third of their balance sheet. Now, how can that happen? How can that happen in such a big number? Well, the bystander effect is basically, in psychology, it is the more supervisors and the more controllers you have on one case, the less likely is there any kind of wrongdoing or problems being raised. Not individually, but in aggregate. So when you go and see the bystander effect, go and have a look. You will see that if you've got one person and that person identifies something might be going wrong, in 75% of the cases, they're going to report it. They're going to raise their hand and say, oh, look, something's going wrong here. The more individuals you add to supervise or control, the less likely the problem is to be reported. And it goes down to, I think, 10 or 15% if you've got more than 6 individuals. And they've done really brilliant tests about putting people in a room and setting a bin on fire and see how many people actually go and report the issue, or smoke coming out of a corner. It's very, very interesting. I really invite you to go and have a look. Why am I saying that? Is because, as you know, sorry, I'm going to go back. You've got, I know I've been in companies where every time there's something wrong, what do? They add one control. And they add one control, and they add one control, and they add more than one control, and then you've got, you know, the fire, the fire team, the fire brigade team being dispatched, and then at the end you've got the maker and checker, and the checker of the checker, the checker of the maker, and then you've got 15 checkers and 15 checkers who are checking the checkers. It's just becoming a mess. And what happens? No one is responsible anymore. You have a dilution of responsibility, which is as such that no one raises a hand, because, well, if no one else is raising a hand, then there's nothing's wrong, right? They think nothing is wrong. And that is why people are not raising their hands when they know some other people are doing the controls and doing the checks. And that is very worrying, because not only are you creating very cumbersome and clumsy processes, but you actually don't even meet the objective. So really, when we're looking at process design, and when you are relooking at processes, if you have a problem, if you have an issue, and you're doing root cause analysis, and the result is, let's add another control, or let's add another checker, think twice before doing so, because you will not get to the objective that you need. You will not resolve the issue. Guarantee that. And many, many psychological tests can support that, that fact. So yeah, diffusion of responsibility. I'm sure you've come across these instances before. So really, control design. We'll have a session on control design and what factors make a control a good control. But very much already think about how many controls do you have to address one risk. Yeah, maybe you need to move it to a different part in the process. Maybe you need to move it early in the process. Because maybe the control needs to be detective and not preventive. Preventive, sorry, not detective. And therefore you don't need necessarily a detective control. So I think this is all to do with, you know, how many do you have controls, you know, real controls defined and implemented. And the second point is, how many of those do you have? And I think as second line, we have really a mission to make processes leaner, to make the customer experience better, and to lower the cost for the organization. So this is really where we can add value. I'm going to open to the last slide is really to wrap up what we've discussed. So establish a strong culture, participate into product and process design, because when it's there, it's too late. Understand the strategy and the business restrictions. So this is about what we talked at first about business, you know, the risk appetite. Know your control, ensure that what you test and monitor is a control and not something else. And then set clear responsibilities. Less is more, and be aware of the bystander effect. I'm conscious of time. We've just gone at, it's already 2 o'clock Qatar time, 3 o'clock Dubai time. I'm happy to take some questions either now. Feel free to leave the session if you have other duties, or feel free to email me any questions you may have. And thank you very much for your attendance.
Hi guys, any questions before we wind up?